Finances should too. Visit a CIBC branch today for free financial advice and achieve what matters to you.
Joe in Abbotsford, BC wants to know about Verizon, VSN on the TSX. I'd like to get David's opinion. It's been on a steady climb. I own some. I'd like to buy some more. And this is another energy infrastructure play.
Yeah, so as I was saying, even in our pure equity portfolios, roughly 30% of the portfolios right now are targeting energy infrastructure assets. So we think that there is a 10-year secular theme in front of us that can lead, A, to rising dividends, and B, to improved valuations. So we can get a multiple expansion and a rising dividend, which could give you a geometric lift in share price. Within that camp, there's a number of them that we own. We do not own Veresen currently. You know, Veresen's best known for that 50% interest in the Alliance Pipeline. And one of the key themes is that much of the liquid-rich gas that they have typically transported down to south of Chicago at Aux Sable is being diverted to other processors in Western Canada to keep the liquids in Western Canada because the demand for liquid-rich gas is going higher. So there's a lot of competition for that gas. And there are several contracts that come up for renewal over the next few years that we think pose some risk to Veresen, where some of the other infrastructure companies don't have that same issue. So we prefer some of the other companies. Veresen is in the right space. They're doing very well. I just think that there might be better names, and we'll talk about one of them later today.
For sure. So the yield on Verizon right now is 7%.
Yeah, it's excellent, but I just think that there is a risk there that some of the others don't have.
Lisa's on the line from Toronto. Go ahead, Lisa.
Hi, thank you for taking my call.
Not at all.
Mr. Burrows, in the past you've recommended Canfor Pulp, which I purchased and did very well, and then sold it upon your recommendation. I know it's been dropping dramatically. I'd like to know what the reason is. Is it a sector section, a problem? And do you think it's time to re-enter? I'll hang up and listen to your comment. Thank you very much.
So, Lisa, I'm glad you did exit when we went to the sidelines. This was a great holding that we were in, but of course it is economically sensitive. And one of the key themes that we saw over the course of the summer, even as the market, was holding up at times, the more economically sensitive companies were underperforming. And there is some question around pricing for Canfor, and of course their distribution or their dividend is dependent on strong pricing. So this is one that we've stayed away from. We tend to try through a difficult market to look for the companies that hold up better than the rest. This has not been one of them. I think that you can wait on this one for a different opportunity. I think that the appetite in the market is for more predictability and more visibility in the ability to pay, and this one, has some sensitivity to the economy.
Here is John on the line from Tillsonburg, Ontario. Go ahead, John.
Hello, David.
Hi there, John.
My question is on Corning. I see today their stock's down roughly 14% on news that consolidated equity earnings are going to be down 30% versus guidance of 5%. Can you tell me, is this a sign of the economic times, or is management that incompetent, or maybe that's too strong a word to not have a better prediction?
The difficulty here is that we're in a market where even companies that are hitting the numbers and doing relatively well are being called into question as to the sustainability. In the case of Corning, the last three earnings numbers have been negative. They got a negative growth rate there. There's questionability again around the sustainability of the earnings, and so I think investors are using the opportunity for any kind of bid in the market to exit companies where there are some questions. And today you've got a quieter market. They've raised more questions about earnings going forward, and the market's voting with their feet. This time of year, you're going to see a lot of these stocks that have underperformed over the course of the year get punted from portfolios, because managers don't want them on the sheets to show how inept that they've been, perhaps. And second, of course, there's the tax loss selling that takes place. So,
yeah, and it seems to be that a customer, they cut prices to accommodate a customer, and then the customer abandoned the contract anyway.
Right. So there's no win there.
James is on the line from London, Ontario. Go ahead, James.
Mr. Burrows, always a pleasure to see you on. My question is on Kinross Gold. I'm pretty well aware of you know, the show me story with the purchase of Redback. It seems as though they've diluted themselves at least 60% since that acquisition. But can you just basically comment, is value ever going to kick in on this stock? It seems to be trading pretty much around net asset value at the time right now. Is value ever going to kick in here?
So, you know, I tend to try and speak to the way that we look through the lenses, and, you know, everybody's going to have a different approach on things. My view is, you know, we come from the top down and say, first of all, market-wise, are we putting money to work? Second, is this a sector that we're focused on? Is there new net money flowing into this group? And I think, first off, that's a question mark, right? That the gold producers have been underperforming the metal and, frankly, underperforming the rest of the market. And then the third thing is it a leading stock within the group that would be garnering new net buyers to the name. And I think in the case of Kinross, really, it's about the worst performing big gold producer. You know, I'm not the one to try and buy something based on pure valuation. I do think we are in a challenged market, and I do think that there are risks. So if you don't have everything going for you, I think you got a tough slug ahead. Technically, the stock broke to new lows recently. I would steer clear. We have very low gold weight. We've only got a couple of names. We've got some Alicer, and we've got some a little bit of Eldorado. We've got some Newmont. But those would be among the stronger performers. And I just think that you don't, again, we're not in the kind of market where investors will invest in things that have a little bit of hair on them, and I think that Kinross is in that camp right now.
Dave is on the line from Saskatoon. Fire ahead, Dave.
Thanks for taking my call.
That's all.
My question is regarding Bank of Nova Scotia for long-term holding, and also place of Bank of Nova Scotia among the three, Bank of Nova Scotia, TD, and Royal. Thank you very much.
Thanks very much.
Okay. So, Dave, going back to start at the sector level, obviously financials have had a very difficult year in general globally. Canadian financials really played catch-up over the last quarter to the downside. Within the financials group, one of the concerns is which companies could be impacted negatively by what's going on in Europe. And, you know, Bank of Nova Scotia has made lots of investments that have worked quite well along the way in South America and the Caribbean. South America does have a more significant risk to what's going on in Spain because some of the big Spanish banks have large exposure in South America. If they're pulling back in South America, there's larger risks, and I think that's why Bank of Nova Scotia is underperforming right now. So the European situation is posing a little bit more risk to some of the growth opportunities that Scotia is seeing. Within the group, I think that Royal has the most significant exposure to capital markets in the U.S., so I would stay away there. Scotia, we just talked about, I would be more inclined to be in a TD, although as unusual as it may be, we have about a 0% weight in financials, because in general, we think that they're having a hard time returning a strong return on equity, and the dividend growth that people have become so accustomed to over the last 15 years really is not likely to be there, so we think their earnings multiple could compress over time, and these could continue to underperform.
We're going to be right back with David Burrows, President, Barometer Capital Management, answering your questions on North American large caps. The number, 1-855-326-6266.
Fast-paced debate for fast-paced finance.